finally hit 100 shares of Realty Income. I got there a lot sooner than planned as I ended up buying more as the price was dropping. This is the first stock in my dividend portfolio to hit 100 shares. My strategy was to get to 100 shares and leave it to drip slowly, which is exactly what I'm going to do, then concentrate on building other positions. 100 shares of Realty Income will provide me $307.20 annually, which works out as $25.60 a month, $5.90 a week, and roughly 84 cents a day. My average buy price is $59.05, which is not the best, but I'm okay with it. It was over $60 until recent purchases. If I let it accumulate, I can buy a share every 3 months with money left over. The aim, of course, is to buy below my average buy price. Realty Income have had a terrible couple of months. Interest rates hikes really spooking investors. I see REITs as cyclical and it will rise again. A lot of analysts tend to agree with this sentiment, with an average 12-month price target of $64.25, which will go way above my average buy price, if of course they can predict the future. Grain of salt there. Let's have a look at the statistics on Simply Wall Street. These are the good points, trading at 50.2% below Simply Wall Street's estimate of its fair value. Earnings are forecast to grow 9.99% per year. Earnings grew by 54.4% over the last year. Pays a high and reliable dividend of 6.07%, which we are all well aware of. Analysts are in good agreement that the stock price will rise by 29.4%, which is higher than what tip ranks have it. Those are the positives. The risks are interest payments are not well covered by earnings. Shareholders have been diluted in the past year. This is something I don't like to see either. Issuing more shares reduces the shareholding you have in the company. Realty Income need to do this to raise capital to buy more properties so that they can continue to grow revenue. If we have a look at the dividend criteria, it's got 6 out of 6, which is as good as it gets. 6.07% dividend yield at the moment, which is higher than the bottom 25% dividend payers in the US market. In fact, it's in the top 25% of dividend payers. Dividends per share have been stable in the past 10 years, and the payments have increased in that time period. The payout ratio of 73.7% means the dividend payments are covered by earnings, plus the current cash flow payout ratio of 78.7% means that the payments are also easily covered by cash flows. Then let's have a look at the price to earnings ratio versus fair value. Realty Income deemed expensive with a current PE at 41.3 times and the fair PA down as 40.4 times. Not a massive difference really. Fair value price, on the other hand, shows it massively undervalued based on future cash flows. Of course, it would be very nice if this comes to fruition. Then the price target that I mentioned earlier by Simply Wall Street is $65.47, which is based on 15 analysts. Let's have a look at future growth. Realty Income's forecasted earnings growth is 10% per year, which is above the savings rate of 2.2%, which is good. The downside is earnings are forecasted to grow slower than the US market, which is 14.3%. Earnings are forecasted to grow but not significantly. Plus side, revenues are forecasted to grow faster than the US market but slower than 20% per year. Then the return on equity is forecasted to be low at 3.7%. A bit of a mixed bag. From their investors' presentation, they show why they are the king of REITs. Historically, stable cash flows with an average of 98.2% occupancy, which is incredible, 99% for last year and this year so far. A strong balance sheet with Moody's A3 stable rating and A- stable rating from S&P Global. What I really like though has been the external growth into European countries, investing $7.6 billion in real estate in the UK, Spain, Italy and Ireland. These properties are leased to 3 of the biggest grocery stores in the UK, Sainsbury's, Tesco and Asda. Carrefour, which is the second largest grocer in Spain, plus B&Q, which is the largest home improvement retailer in the UK and number 2 in France. These companies have been around for decades and will continue to expand. The international and domestic growth means that Realty Income is well diversified over a few market segments. The top 20 clients are household names and they have a clear strategy of how they are going to continue to grow. So I'm happy to hold on to these shares for a very long time. Collect the dividend, reinvest and let it compound. As usual, thanks for watching. If you enjoyed the video, please like and subscribe.